Hello everyone, and welcome back to another episode of Mind and Liberty. I'm your host, Gus. Today, we're diving into a topic that's sparking intense debates across finance, tech, and socioeconomic circles. The dramatic surge of Bitcoin and what it means for the future of global finance. If you've been following the news, you've likely seen the headlines: Bitcoin reaching new highs, talks of economic uncertainty, and the evolving landscape shaped by regulation and innovation. But what's really driving these seismic shifts, and is there more than meets the eye? Imagine this: Bitcoin's value soaring to nearly $50,000, a number that has heads turning in every corner of the investment world. For some, this feels like déjà vu, a resurgence reminiscent of 2017's market highs. Only this time, the stakes are higher, and the context more complex. The question on everyone's mind: are we on the brink of another bubble, or is this the start of a new financial era? The plot thickens when you add politics to the mix. Just as the price of Bitcoin surged, we saw another global shift unfold: the election of Donald Trump. Now, whether you align with his policies or not, one thing is clear: Trump's approach to economic growth and deregulation has left a lasting impact on the financial ecosystem. How much of this recent Bitcoin rally can be attributed to post-election optimism? To understand that, we need to peel back the layers of policy, public sentiment, and global economic response. In the months leading up to the election, investors around the world were already bracing for impact. Economic uncertainty often pushes people to look for alternative stores of value, and Bitcoin, with its decentralized nature, becomes a prime candidate. Fast forward to post-election, and we witnessed a significant uptick in interest both from institutional investors and everyday people wanting a piece of the action. This isn't just speculation, it's a calculated move by those who understand the interplay between policy and market confidence. But what makes this current rally different from previous ones? One word: data. We now have more sophisticated tools to analyze market behavior. Metrics like the Meyer multiple and MVRV ratio give us insights that were less mainstream during the earlier boom years. For instance, the Meyer multiple, which compares Bitcoin's price to its 200-day moving average, can tell us if we're in overbought territory. Spoiler: right now we're well above that historical baseline, indicating a potential cooling-off period ahead. Yet, in the grand scheme, these indicators aren't foolproof. They're more like compass points, guiding savvy investors through uncertain waters. Speaking of data, let's touch on trading volumes. At the peak of election-related excitement, spot market trading hit an astonishing multi-billion-dollar mark. That kind of volume is not just driven by retail investors getting caught up in the hype. It signals a deeper shift where larger institutions are starting to play a bigger role. And why wouldn't they? As the world's largest economy faces political and economic recalibration, hedging against traditional assets with digital alternatives makes strategic sense. Now, here's a twist that could shape the conversation for years to come. Recent chatter suggests that the US may be contemplating the creation of a strategic Bitcoin reserve. If that sounds radical, consider this: nations have long maintained reserves of gold as a hedge against economic downturns and currency devaluation. But gold, while still valuable, lacks the versatility and rapid appreciation that Bitcoin offers. If the US were to build a Bitcoin reserve, the ramifications would be far-reaching, not just in terms of price, but for the entire global economic order. You might be wondering, why now? Why would the US entertain such a move at this stage? The answer lies in macroeconomic trends. The devaluation of fiat currencies isn't a conspiracy theory. It's an observable fact tied to inflation and fiscal policies aimed at sustaining economic growth. As central banks around the world print more money to stimulate economies, a strategy that's been particularly aggressive since the COVID-19 pandemic, the inherent value of traditional currencies faces downward pressure. This environment creates fertile ground for assets like Bitcoin to thrive. The implications of this shift are profound. If the US were to announce even preliminary plans for a Bitcoin reserve, it would signal a monumental vote of confidence in the cryptocurrency market. It could potentially trigger a domino effect, with other countries racing to secure their own slices of the digital pie. This would not only boost the price of Bitcoin, but could also catalyze an era where blockchain technology is fully integrated into the world's financial infrastructure. Let's pause for a moment and consider the other side of the coin: regulation. Historically, one of the biggest barriers to widespread Bitcoin adoption has been regulatory uncertainty. With Trump's administration, we saw a mix of deregulation in financial markets and a strong pro-business stance, which fueled optimism among investors. But with that optimism comes risk. If the regulatory environment shifts unpredictably, whether through sudden taxation measures or restrictions on cryptocurrency transactions, the market could see abrupt reversals. What does this mean for you, the investor or curious onlooker? It means vigilance is key. Market data is your ally, but it's not the only tool in your arsenal. Understanding the geopolitical and macroeconomic landscape is just as crucial. For example, consider the MVRV ratio, which compares Bitcoin's market value to its realized value. Historically, when the MVRV ratio climbs above certain levels, it indicates that investors are in profit territory and might start selling to lock in gains. Sound familiar? It should. These are the same signals we saw in 2017 before the market corrected. But let's not jump to conclusions too quickly. While history often rhymes, it doesn't always repeat. The ecosystem today is vastly different from what it was just a few years ago. Institutional adoption is no longer just a buzzword, it's reality. Major financial firms and publicly traded companies are now holding Bitcoin as part of their balance sheets. This trend shifts the narrative from Bitcoin being a speculative asset to it becoming a strategic one. The result, even if corrections occur, the base level of support is likely to be much stronger than before. Still, skepticism is healthy. It's easy to get caught up in the hype, but smart investing is about balancing excitement with caution. When we look at the potential benefits of a US Bitcoin reserve, it's tempting to assume the market would only move up from there. However, with such moves come geopolitical ramifications. Would rival countries like China, which has taken a different approach to cryptocurrency, ramp up its own blockchain initiatives to compete? Would this escalate into a new kind of digital arms race, where technology and currency supremacy intertwine? These are questions worth considering as we look to the future. Now, let's pivot slightly to a topic that resonates with the everyday investor. Long-term holding, or, as it's popularly known in the crypto community, hodling. For those unfamiliar with the term, hodling is the practice of holding on to cryptocurrency for an extended period. Regardless of short-term price fluctuations, this strategy has gained traction as more people view Bitcoin not just as a speculative asset, but as a long-term store of value, similar to gold. The macroeconomic backdrop further supports this viewpoint. With fiat currencies devaluing due to inflationary pressures, holding an asset that's limited in supply, like Bitcoin, with its capped 21 million coin supply becomes an attractive proposition. This is particularly relevant in an age where central banks continue quantitative easing programs that pump money into the economy, but erode the purchasing power of that money over time. But don't just take my word for it. Look at the behavior of institutional players. When companies like MicroStrategy and Tesla make substantial Bitcoin purchases, it's not just a marketing move. It's a strategic hedge against inflation and potential economic downturns. This shift in strategy among large corporations isn't happening in a vacuum. It reflects a growing consensus that Bitcoin, and, by extension, other cryptocurrencies, are here to stay. Let's talk strategy for a moment. If you're an individual investor trying to navigate this space, it's essential to understand your risk tolerance and time horizon. Are you looking for quick gains, or do you see yourself as part of the long-term movement that views Bitcoin as the future backbone of a new financial system? Your approach should align with these goals. Keep an eye on data points like the Meyer multiple and MVRV ratio, but also stay tuned to policy shifts and broader economic indicators that could impact the market. Now, back to the issue of regulation. The US has been relatively ambivalent about its crypto policy, at least until now. While some states, like Wyoming, have embraced blockchain technology and favorable cryptocurrency regulations, others are more cautious. However, with Trump's influence still a part of the broader political narrative, and new leadership potentially adopting his economic blueprint, the future regulatory landscape could be poised for more positive developments. An administration with a pro-business mindset may see the advantages of fostering innovation in the crypto space, while balancing the need for consumer protection and financial stability. What could a supportive regulatory environment look like? Imagine clearer tax guidelines, streamlined compliance measures for crypto businesses, and more transparent pathways for institutional investment. These moves could not only bolster investor confidence, but also encourage more companies to enter the space, further legitimizing Bitcoin as an asset class. Here's another aspect that might surprise you. Bitcoin isn't just an investment, it's part of a larger socio-economic narrative. The idea of decentralization appeals to a growing segment of the population disillusioned with traditional financial systems. Trust in banks and government-backed currencies has been eroded over the past decade, accelerated by events like the 2008 financial crisis and more recent economic policies perceived as benefiting the few at the expense of the many. Bitcoin, with its decentralized ledger and transparent system, represents a kind of financial independence that aligns with the values of self-sovereignty and empowerment. But let's be real, this independence comes with risks. Volatility is the price of freedom in the Bitcoin world. Prices can swing dramatically in either direction, driven by a combination of market sentiment, geopolitical events, and investor behavior. This isn't a playground for the faint of heart. Yet, those who embrace this volatility with a well-thought-out strategy often find that the rewards outweigh the risks over the long term. So, where does this leave us? With Bitcoin's price nearing $50,000, we're in a territory that demands both caution and excitement. The trading volumes and high MVRV ratios signal a heated market, but historical data suggests that these moments often precede significant corrections. However, corrections aren't necessarily bad. They're part of the market's natural cycle. For those who've been in the space long enough, this is just another chapter in Bitcoin's evolving story. If you're sitting on the sidelines wondering whether to jump in, or if you're already invested and trying to decide your next move, remember this: the narrative around Bitcoin is shifting. It's no longer just a digital asset that exists on the fringes of finance. It's becoming a part of mainstream conversations, influencing how nations consider their economic strategies and how companies plan their long-term investments. And this brings us full circle to the implications of a potential U.S. strategic Bitcoin reserve. Such a move would be unprecedented, sending shockwaves across financial markets worldwide. It would validate what early adopters have believed all along, that Bitcoin is more than just an experiment. It's a transformative force in the world economy. Whether or not this vision comes to pass, the mere discussion of it underscores Bitcoin's growing influence and legitimacy. As we look ahead, there are bound to be twists and turns. The market will rise, and it will fall. News of regulation, political changes, and economic data will play their parts in this unfolding drama. Your job, as an informed participant, is to stay educated, keep a pulse on these shifts, and think long-term. Because, at the end of the day, while Bitcoin's price might fluctuate, the principles it represents, decentralization, financial freedom, and innovation, are here to stay. So, keep your eyes on the data, but don't lose sight of the bigger picture. Whether Bitcoin's price soars to unimaginable heights or faces a correction, what we're witnessing is the evolution of money itself. And being part of that conversation, equipped with the right insights and strategies, is what will set you apart. Thank you for tuning in to Mind and Liberty. I'm Gus, reminding you to think critically, stay informed, and always keep pushing forward. Until next time, take care and invest wisely.